Strategic versus tactical asset allocation. Strategic allocation is like setting the long-term diet for a person. You decide today that 60% of calories will come from carbs, 30% from protein, and 10% from fat, and you stick to it for years. In finance, the calories are the percentages of money put into asset classes, for example, 50% US equities, 30% bonds, 20% real estate. The mix is chosen based on the investor's risk tolerance, investment horizon, and financial goals. It changes only when those fundamentals change. For example, a younger investor becomes older. Tactical allocation is the short-term seasoning you add to the diet, a pinch of spice for a special occasion. It involves temporarily tilting the strategic mix to take advantage of market conditions, for example, moving 5% from bonds to emerging market equities when you expect a strong earnings cycle. Tactical moves are usually short-lived, months to a couple of years, and are driven by macroeconomic forecasts, valuation signals, or sentiment. The key difference: strategic is capacity-driven, risk capacity, while tactical is opportunity-driven, price-driven. Both must be documented in a policy statement that defines the strategic target, the allowed tactical range, and the governance process for making tactical decisions. MPT treats a portfolio like a weighted basket of fruits. Each fruit asset has an expected taste return and a chance of being sour risk. The goal is to get the best average taste for a given sourness level. Mathematically, let W equal W sub 1, W sub n be the weight vector. Sum W sub I equals 1. Expected portfolio return. Mu sub P equals sum from I equals 1 to n of W sub I mu sub I, which equals W transpose mu. Portfolio variance risk. Sigma sub P squared equals W transpose sigma W, where sigma is the covariance matrix of asset returns. The efficient frontier is derived by solving. Minimize W transpose sigma W subject to W transpose mu equals mu star, and sum W sub I equals 1 for every possible target return mu star. Using Lagrange multipliers, we obtain closed-form solutions. W of mu star equals open bracket a sigma inverse mu minus b sigma inverse 1 close bracket divided by a c minus b squared, plus mu star times open bracket c sigma inverse 1 minus b sigma inverse mu close bracket divided by a c minus b squared. Where A equals 1 transpose sigma inverse 1, B equals 1 transpose sigma inverse mu, C equals mu transpose sigma inverse mu. Plotting sigma sub p, mu sub p for all mu star yields a convex curve, the efficient frontier. Portfolios on this curve give the highest expected return for a given level of risk. Any portfolio below the curve is suboptimal because you could achieve the same risk with a higher expected return. Real-world analogy. Imagine you are buying a car. The price is the risk you are willing to bear, higher price equals higher risk, and the fuel efficiency is the expected return. The efficient frontier tells you the set of cars that give the best fuel efficiency for any price you are willing to spend. CAPM links an asset's expected return to its systematic risk beta, the part of risk that cannot be diversified away. Think of beta as a temperature gauge that tells you how much the asset's price moves when the overall market, the weather, changes. Mathematical formulation. Beta I equals covariance of Ri and Rm divided by variance of Rm, where Ri is the return of asset I and Rm is the market return. The expected return under CAPM. Expected return of Ri equals risk-free rate plus beta I times expected return of Rm minus risk-free rate, where Rf is the risk-free rate, for example Treasury bill, and E of Rm minus Rf is the market risk premium. Example, suppose risk-free rate equals 2%, market expected return equals 8%, premium equals 6%. A stock with beta equals 1.5 would have an expected return of 2% plus 1.5 times 6% equals 11%. This tells investors what return they should demand for taking that level of systematic risk. CAPM also provides the equilibrium market weights used later in the Black-Litterman model. The market implied excess returns are proportional to betas, i.e. pi equals lambda sigma WMKT, where lambda is the market price of risk and WMKT are the market cap weights. Mean variance optimization, quadratic programming numerical example. Find weights W that minimize portfolio variance subject to a target return of 10% and full investment weights sum to 1. Assume three assets with the following data. Asset A expected return 8% standard deviation, 12% covariance is sigma sub a B equals 0.0012 sigma sub a C equals 0.0008. Asset B expected return 12% standard deviation, 18% covariance sigma sub BC equals 0.0024. Asset C expected return 15% standard deviation, 25%. Covariance matrix sigma equals a 3 by 3 matrix with entries first row 0.0144, 0.0012, 0.0008. Second row 0.0012, 0.032, 0.0024. Third row 0.0008, 0.002, 0.0625. Set up the quadratic program, minimize W transpose sigma, W subject to W transpose mu equals 0.10 and 1, transpose W equals 1. Using the Lagrangian method or any quadratic programming solver, we obtain the optimal weights rounded W star approximately equals 0.45, 0.35, 0.20. Check 0.45 times 8% plus 0.35 times 12% plus 0.2, 0 times 15% equals 10%. Portfolio variance sigma sub p squared equals W star transpose sigma W star, approximately equals 0.0144, so sigma sub p approximately equals 12.0%. Interpretation: the optimizer puts the most weight in the lowest volatility asset A while still meeting the 10% return target, and only a modest amount in the high return high volatility asset C. This illustrates how mean variance balances return against risk. In practice, the quadratic program is solved with software, for example Python CVXBY MATLAB QuadProg. The constraints can be extended to include limits on individual asset sector caps, or a minimum exposure to a particular class, turning the problem into a realistic portfolio construction tool. Black-Litterman model incorporating views. The Black-Litterman framework starts with the market equilibrium, implied returns the prior derived from cap M, then blends in investor views to produce a posterior expected return vector that can be used in mean variance optimization. Step by step, equilibrium returns pi. Pi equals lambda sigma WMKT, where WMKT are market cap weights, sigma the covariance matrix, and lambda the risk aversion coefficient, often lambda equals E of R sub M minus RF divided by sigma sub M squared. Express views in matrix form. Q is a vector of view returns P maps assets to each view. Asset A will outperform asset B by 3% becomes P equals 1 minus 10, and Q equals 0.03. View uncertainty, omega a diagonal matrix representing confidence in each view smaller values, equals higher confidence. Posterior expected returns. Mu BL equals left bracket tau sigma inverse plus P prime omega inverse P right bracket inverse, left bracket tau sigma inverse pi plus P prime omega inverse Q right bracket. Where tau is a scaling factor, often 0.025, reflecting uncertainty in the prior. Real-world analogy: think of a chef the market who has a standard recipe. The equilibrium returns you the sous chef have a taste test your view that suggests adding a pinch more salt to the soup. The Black-Litterman model blends the chef's recipe with your pinch, weighing them by how confident you are in your taste test. Result: mu BL replaces the original mu in the mean variance optimizer, yielding a portfolio that respects both market consensus and the manager's insights. Practical tip: when many views are provided, the matrix algebra automatically ensures they are combined consistently, avoiding the ad hoc adjustments that can lead to unintuitive allocations. Factor-based diversification: multi-factor models and risk attribution. Instead of looking at individual stocks, factor models decompose returns into common sources of risk, like breaking down a song into melody, rhythm, and harmony. The most popular is the FAMA French three-factor model. Ri minus Rf equals alpha I plus beta Im times Rm minus Rf plus beta I SMB plus beta I HML plus epsilon, where market M captures overall market movements. SMB small minus big captures size premium small cap outperformance. HML high minus low captures value premium high book to market stocks. Modern extensions add profitability, investment momentum, etc., creating a 5-factor or 6-factor model. Risk attribution works by calculating how much each factor contributes to portfolio variance. Step 1. Estimate factor exposures, factor betas, for each asset. Step 2. Form the factor covariance matrix sigma F. Step 3. Portfolio factor exposure beta P equals W prime beta, where W are asset weights. Step 4. Factor contribution to variance sigma P F squared equals beta P prime sigma F beta P. Step 5. Residual specific risk sigma P epsilon squared equals W prime omega, W, where omega is the diagonal matrix of asset-specific variances. Analogy: imagine a garden where sunlight, water, and soil quality are the 3 factors influencing plant growth. By measuring how much each factor affects each plant, you can allocate resources, fertilizer, irrigation, to balance the garden's overall health. Diversification benefit by holding assets with opposite factor exposures. For example, a small cap growth stock with negative SMB exposure. You reduce the portfolio sensitivity to any single factor, achieving smoother performance across market regimes. Value at risk (VaR) answers. What is the worst loss we can expect over a given horizon with a certain confidence? For a normal distributed portfolio return R(n mu sigma squared), one day 95% VaR is VaR 95% equals negative open parenthesis mu plus Z 0.05 sigma close parenthesis, where Z 0.05 equals negative 1.645. Example: portfolio mean equals 0.05% per day, sigma equals 1%. VaR 95 equals negative open parenthesis 0.0005 plus open parenthesis negative 1.645 close parenthesis times 0.01 close parenthesis, approximately 1.64% loss. Conditional VaR, see VaR, expected shortfall, average loss beyond the VaR threshold. For the normal case, see VaR 95% equals negative open parenthesis mu plus open parenthesis phi of Z 0.05 divided by 0.05 close parenthesis sigma close parenthesis, where phi is the standard normal probability density function. Using the same numbers, phi of negative 1.645 equals 0.103, see VaR 95 approximately 2.06% loss. Tracking error, TE, measures how closely a portfolio follows a benchmark. TE equals square root of open bracket 1 over T times sum from T equals 1 to T of open parenthesis R sub P comma T minus R sub B comma T close parenthesis squared close bracket. Example: over 5 days, portfolio benchmark differences are 0.2%, negative 0.1%, 0.0%, 0.3%, negative 0.2%. TE equals square root of open bracket open parenthesis 0.002 squared plus open parenthesis negative 0.001 squared close parenthesis plus 0 squared plus open parenthesis 0.003 squared close parenthesis plus open parenthesis negative 0.002 squared close parenthesis divided by 5 close bracket approximately 0.0018 equals 0.18%. Interpretation for managers. VaR gives a regulatory style loss ceiling. See, VaR tells you the average loss if that ceiling is breached, more useful for tail risk-aware investors. Tracking error is the volatility of active risk. A low TE less than 5% indicates a portfolio stays close to the benchmark, suitable for index fund managers. A higher TE suggests more active positioning. All 3 measures can be incorporated as constraints in the mean variance or Black-Litterman optimization. For example, limit VaR less than or equal to 3% while maximizing return. Rebalancing is like trimming a hedge. You cut back branches, overweight assets, and let others grow underweight so the shape stays as intended. 2 main approaches. Periodic, calendar-based, rebalance every quarter or month regardless of drift. Simple to implement, but may trigger unnecessary trades when the portfolio is already close to target. Threshold band-based, set a tolerance band, for example plus or minus 5%. Rebalance only when an asset's weight leaves the band. This reduces trades but requires monitoring. Transaction cost model. Total cost equals C fixed times N trades plus C prop times the sum of absolute delta W sub I, where C fixed is per trade commission, C prop is a percentage of the dollar amount traded, and delta W sub I are weight changes. Optimization, combine the rebalancing decision with cost minimization. Minimize over delta W of 1/2 times open parenthesis W plus delta W close parenthesis, transpose sigma open parenthesis, W plus delta W close parenthesis plus lambda times cost of delta W. Subject to the sum of W plus delta W equals 1 in any policy constraints. Practical rule of thumb, Vanguard 2014 study. Rebalancing when drift exceeds 10 to 15% of the target weight usually yields the best trade-off between keeping risk in line and limiting costs. Real-world example, a 60-40 stock bond portfolio drifts to 65-35 after a strong equity rally. With a 5% band, the stock weight 65% is outside the band, 55 to 65%. A rebalance brings it back to 60-40, incurring $200 in commissions plus a 0.05% market impact cost on the $2 million moved, that is $1,000. The manager compares this $1,200 cost to the risk reduction, lower tracking error, and decides to rebalance if the benefit outweighs the expense. Technology tools, automated rebalancing engines, now embed this cost-aware algorithm, executing trades only when the net expected utility gain is positive. A 35-year-old investment policy statement specifies a strategic mix of 70% global equities, 20% bonds, 10% alternatives. 6 months later, the equity market has risen 12%, while bonds fell 2%. The manager wants to tilt towards bonds, tactical, to capture a perceived mean reversion. 1. Verify the investment policy statement allowance for tactical moves, for example plus or minus 5% tilt, maximum 1-year horizon. 2. Quantify the proposed tilt, for example move 5% from equities to bonds, resulting in new weights 65, 25, 10. 3. Estimate the expected return and risk of the tactical portfolio, using capital asset pricing model or factor model. 4. Conduct a cost-benefit analysis, expected excess return versus transaction costs and tracking error budget. 5. Document the decision, set a review date, and monitor execution. Question 2. Mean variance optimization. 4 assets with expected returns and standard deviations, assuming 0 correlation. Asset data, a mu6%, sigma 10%, B mu9%, sigma 15%, C mu 12%, sigma 20%, D mu 5%, sigma 8%. Covariance matrix sigma is diagonal with variances 0.001, 0.0225, 0.040, 0.0064. Minimum variance weights. W sub MV equals sigma inverse 1 divided by 1 transpose sigma inverse 1. Because sigma is diagonal, sigma inverse consists of the reciprocals 100, 44.44, 25, 156.25. Resulting weights approximately 0.32, 0.14, 0.08, 0.46. Portfolio return equals 6% times 0.32 plus 9% times 0.14 plus 12% times 0.08 plus 5% times 0.46, approximately 6.2%. Portfolio standard deviation equals the square root of W transpose sigma W, approximately 9.1%. Sharpe ratio equals 6.2% minus 2% divided by 9.1%, approximately 0.46. Maximum Sharpe tangency portfolio. W sub T equals sigma inverse times mu minus risk-free rate times 1, divided by 1 transpose sigma inverse times mu minus risk-free rate times 1. Mu minus risk-free equals 4, 7, 10, 3%. Applying sigma inverse gives 400, 467, 250, 469. Normalizing yields weights approximately 0.24, 0.28, 0.15, 0.33. Resulting Sharpe approximately 8.5% minus 2% divided by 8.7%, approximately 0.75, higher than the minimum variance portfolio. Question 3. Black-Litterman views. Analyst expects European equities to outperform the market by 2% over the next year. Euro stocks weight in the global equity market is 8%. Step 1. Compute equilibrium returns pi equals lambda times sigma times market weight, assuming lambda equals 3. Step 2. Define view matrix P that picks the Euro Stoxx position, a row vector with a 1 in the Euro Stoxx column. Step 3. Set view vector Q equals 0.02, 2% excess return. Step 4. Use tau equals 0.05 and omega equals 0.02 in the Black-Litterman formula. Mu sub BL equals the inverse of tau sigma inverse plus P transpose omega inverse P, all inverted, times tau sigma inverse times pi plus P transpose omega inverse Q. Result: the expected return for European equities is shifted upward by roughly the view magnitude, with a small spill over to correlated assets. Step 5. Feed mu sub BL into a mean variance optimizer to obtain the revised portfolio weights.